everyone, welcome to the VIP weekly meetup. I got a nice little presentation for everyone today, a macro review and a deep dive into DRIO earnings. But first, StoryTrading is not an investment advisor, and investing in securities involves significant risk of loss. This presentation is being recorded. It's going to be provided to our VIP member community throughout the week, and it'll be going up on social media in about 1 week's time. So for tonight, we'll do a macro update, talk about the possibility of a bear market rally. We already saw 1 day up Friday, so we'll talk about where that can possibly go. I'm going to review the purchase I made in ARK. Those of you who've been paying attention, I said, hey, when ARK goes to $35, I'm going to step in, and I did. But I didn't have the guts to do it at 35. I waited for confirmation, went up to like 38, and then I got it. So we'll talk about that. Wheat, USO, fertilizer stocks, and a little bit on the new FANGs. I think given some geopolitical updates, important to touch on those again. And I'll get into DRIO, not only a look at the 4 pillars, but is this an inflection point? All right, so I want to give you guys an update on DarioHealth, DRIO. This has been one of my favorite stocks. I've been in multiple presentations on it over the past 2 years. I've interviewed the CEO and other executives over the past couple of years. So I know this company inside and out. $129 million market cap now. It closed Friday at $5.85. I held on to this the whole way down. It's been painful because I originally got in at 7, rode it all the way up to 31. I sold some in like the 20s and 30s, but I'm sure I also averaged up on the way. 7 was my initial entry. On the way down, I probably picked up more, right? So something that was a huge gain for me, I probably ended up at in a huge, paper loss, although I did take some profits. I have to check. I don't know where I stand now. But in any case, I stuck with it because they were executing, basically. Everything was like on a delay, but everything that Erez has been saying, the CEO of Dario, has been coming true, just taking more time. I love the space. I love how he does offerings. There's lots of reasons why I've been in this. You can see the multiple videos on it. But you can see here, we broke 20 DMA and hit the 50 DMA after earnings. So we'll talk about some of these 4 pillars: sentiment, catalyst, fundamentals, and technicals on Dario. But I want to propose something here. I think Dario, this was an inflection point quarter. We'll talk about in a second, not only quantitatively, but qualitatively. And this reminds me of when I made that inflection point call. For those of you who didn't see it, you can see it on YouTube. Air was like $2.50. I went on, I said, this is an inflection point. Sunday night presentation at Air at 250. Now that does not mean this stock's going to go up 10 times in 4 months. It's a totally different environment, right? The stock market now, and the macro is different, but it feels the same to me, the way I analyze stocks on the 4 pillars, right? It feels the same. So let's talk about why it feels the same. Break it down. So the quantitative portion, the quantitative inflection point, here are the earnings. They have 7 analysts covering them. They beat the most bullish of all the analysts. The average was 6.87 million. I think the high end was 8 million. And I came in at 8.06 million. They beat on the bottom line. Again, the most bullish analysts, they came in above it, a 74-cent loss. Okay. Now, people are not familiar with this opportunity with this company. Will say, oh, they're still losing money. Kryptonite, staying away from it, not in this market. And I get that. Probably going to be their loss. So other thing we saw was a significant sequential drop in OPEX and increase in gross margins sequentially. We also saw a significant sequential gain in revenue, and this is all organic because they've had many acquisitions over the past year, but from Q4 to Q1, there was no additional revenue coming from new businesses they acquired in Q1. It was all organic growth, Q4 to Q1. So all really exciting to see this quarter. And also they talked about a little bit on the call about a pathway to profitability without a dilutive offering, as we've been talking about as well last few weeks of StoryTrading. And the other thing, it's quantitative. They gave some numbers, but this national insurer that we're waiting for them to go from a phase 1 to a phase 2 expansion, which is when they can PR it. They said it's ahead of schedule, that expansion. So hopefully we'll get a PR any day or any week. And it represents an additional 8 figures in annual revenue they can get. and access to tens of millions of customers. This is a top 5 insurer. It's rumored to be, based on some analyst reports out there, Aetna. So very few people probably know that if it is Aetna. So when that comes out, that'll obviously be great for the stock. So that's the quantitative look. Now, qualitatively, why do I think it's at inflection? Well, it's the first time they beat analyst estimates, right? Because they kept being behind schedule. So they went from being behind schedule to not only being on schedule, but all of a sudden being ahead of schedule, just like that. This quarter from Q4 to Q1, after 6, 7, 8 quarters of being behind schedule, they leapfrogged and they went ahead of schedule in terms of how quickly the revenue is ramping because of all of these employer contracts, which kicked off Q1 in January here. And the other thing qualitatively is now the B2B business, for the first time ever in their history, is they're getting more revenue from the B2B business than the direct-to-consumer business for the first time ever. Very important piece of data. And interesting, they have continued momentum. They're signing employers left and right. They have like 60, 70 accounts now. They signed like another 14 over the quarter. And, you know, they have no signs of slowdown in both the employer and insurer space. And this is contrary, the exact opposite of what TDOC said in their earnings a couple weeks ago, when they said they're having, you know, that they said the employers and insurers are taking their time and it's a longer sales cycle and we're having trouble signing people. So, you know, I went out there and actually Dario put a note out there, an analyst note that they were distributing privately. And one of the analysts came out right after the day after the TDOC report and upgraded. Dario put a $31 price target. So they said they think they're taking business from TDOC. I put an article out on Benzinga that, you know, is Dario eating TDOC's lunch? So I think there's some divergence here, and it speaks to the strength of the product that Dario has. The other thing qualitatively that they talked about is, hey, they can possibly get to profitability without a line of credit. Man, they have probably 70 million in cash right now. I understand they're losing a lot of money, but they're growing very quickly. And based on, well, I have to dig into this deeper, still doing a little bit more research and some getting some help with some colleagues on modeling this. But I think there's a possibility that they can get to cash flow break even without any additional capital. Now, as a backstop, the company is pursuing a non-dilutive line of credit to get them over and hold them over into cash flow profitability. So something to look at. Now, Sanofi, there's a $30 million deal with Sanofi that it's hit the ground running. They're already selling the product through their channels. They're launching studies, health studies to quantify how, you know, great the service is for insurers and everything. And although they don't need the money, they've promised Sanofi the opportunity to invest in the company. So they're not desperate for that cash. If and when Sanofi wants to invest, I anticipate that'll be on very good terms for Dario equity investment. So, and that'll bring in money. Again, they don't need it, so they can, you know, have great leverage in negotiations. And that for sure will probably give them all the cash they'll need to reach cash flow profitability. All right. So check out this chart. You can see, I mean, there's some divergences in here. I mean, what was this one? This was, that was, yeah, okay. I guess that's when I got involved here at 7. So forget about everything here. Dario really came on board here when they got huge financing, okay? But since then, after they got that huge financing and everyone started taking them seriously, you can see the general direction of TDOC and Dario. They've been tracking each other, especially at the very high and especially since November as all the growth stocks started taking off. Those are the two most important things that I take from this, right? That high and this drawdown. Now, what happened recently with everything we're talking about? Look at this. Look at this outperformance. TDOC is down 48% and Dario is down 3% during this period. Is it down 3%? I'm not even sure it's down. Or does that say up 3%? I'm not sure. Okay, no, that's down 3% on this chart, but on my other, well, I guess it may have changed since Friday or whatever, but I'm going to show you another piece of interesting data about 1 month chart in a second. So in any case, Man, if you were trading with us and I talked about the 20 DMA and the 50 DMA and predicted that 585 would be resistance on Friday, the stock closed at 586, not bad, penny off. RSI is, to me, is not overbought, and it is significant resistance though, because if this breaks 585, I mean, this is so like unprecedented or unusual to see a chart like this. You cannot find a chart like this that's possibly on the verge of a bullish breakout. I looked at over 30 charts of tech stocks, growth stocks, any kind of risk asset, right? And Dario was the only one that was green. Now that chart I showed was negative 3%, but yeah, maybe it's because I did it Friday and this one's over the weekend. I'm not sure. But when I looked at it on my TD Ameritrade app, it was the only stock that was green, even if it was minus 3%. It's outperforming every single other risk asset over the past month. It's like the only stock out of anything I track that is remotely possibly bullish. And the ramifications of breaking this 50 DMA, if it does, are pretty great, which is why it might not break it. Because who can imagine a stock breaking out and heading towards 10? Like, that's hard to imagine this macro environment. So the shorts might be very motivated to sell this off at 585 tomorrow. But on the other hand, if the market opens green, right, and the RSI is not terribly overbought, who knows? Maybe this can break out and it's going to be like the only stock that can possibly, wow, if that goes up to that 50 DMA, you're talking, wow, is that a stock that's going to be green for the year if it reaches it? It's possible. It really is. But before then, though, there's a lot of resistance here in the low sevens you got to take care of. So we'll see what happens. I'm not like holding my breath because of the macro, but I just really like the divergence I'm seeing and the relative outperformance of Dario. A couple other things, analyst coverage. I mentioned earlier, they beat the most bullish of 7 analysts on top, bottom line, top and bottom line. Now, right before the report, I mentioned $31 price target. That was LifeSci Capital on the strength and on the, honestly, at this point, the credibility of Erez. Erez Raphael, everything he's talked about over the last 2 years has come true just on a delayed timeline. So when he's going out there and defending the stock, when TDOC comes out with that terrible report, analysts believe them. I believe them. LifeSci Capital came out before the earnings report, put a $31 price target. Now, after the report, we had Craig Hallam come out, reiterated a buy, $18 price target. Alliance Global upgraded from hold to a buy. I couldn't find the price target on that. So that's the analyst activity happening so far. I want to mention some risks, okay? Because those of you know, or in the SMSI room, I'm long SMSI, but I like to bring up the risks. And the reason I like to bring up the risks is because so many people in that room are so bullish that I feel I have a responsibility to bring up the risk, because at least for me, you know, what happens is I have a very hard time sticking with my rules. And let's say I have a rule of a max allocation of 15% of stock, 15% per stock. Some may be a 10, some may be a 20, right? But for me, it's pretty much impossible for me to stay disciplined and follow that rules unless I have a qualitative understanding of what the risk is, right? When we hear people talking in the SMSI room, like, oh, you're holding a $10 bill for $3, like, I know people and I know traders, and that means you're going to have a shit ton of people saying, oh, I'm going to put my entire net worth in it. It's a $10 bill for $3, or I'm going to break my rules and go 50%, 60%, 70%, right? So I always like to remind myself of the risks, because if I can't come up with risks and I can't come up with what the bear theses are, I might end up going 50% Dario. All right. That's just me. And I think it might be a lot of other people too. So let's talk about the risks so that we can have some qualitative reasoning to stay disciplined quantitatively. So what are those qualitative reasons that this might not work? Well, we talked about financing and how I'm bullish about that, but it's not a guarantee. Can they avoid a dilutive financing? Because I'm thinking this bear market can be several more quarters, right? We could be talking about a SPY or a QQQ that's down 30 to 50% from here 2-3 quarters from now, right? So right now, Dario doesn't need money, but what if something trips up, something gets delayed, right? There's some hiccup in the business, and then 2-3 quarters from now, They need to raise money when the NASDAQ is 40% lower. Well, that's going to be terrible for the long-term price targets, right? If they have to raise money at like $4, right? That's a risk. You got to be aware of it, right? That's a reason not to over allocate. There's another reason. This national insurer, this phase 1 to phase 2 rollout that we talked about, right? What are we waiting for, right? This is actually, I'm getting on a call with Dario tomorrow, and I have a number of questions. This is one of them. What if they're still evaluating the efficacy of this product? And the reason that came to my mind again is because Sanofi, as part of the relationship, is launching a bunch of medical studies, right? Ostensibly to prove that this product will help improve outcomes, right? Maybe number 2 and 3 here are somehow linked, right? That the phase 2 rollout didn't happen. Maybe Aetna or whoever it is evaluating data from phase 1, and they're just waiting until they're sure that outcomes are improved, right? Because the whole point is they want to save money, right? They're offering this for free for their members so that they pay out less in other health complication costs. So that's another risk. What if those studies come from Sanofi? Now, there are studies out there already, by the way, and they've published a few of them. You can go look at the PR history over at Dario, and you can see some of their studies. To me, those studies don't seem like, wow, right? They're like, I guess they're statistically significant, which is cool, or it's important, you know, but you're talking about like 30% improvement in HbA1c, 25 to 30%. Everything was like 25 to 30% improvement, something like that. Maybe there was a 35% improvement, but it's not like someone hits you over the head like, oh, results improved by 80%, right? Like that gives you confidence, right? Now, I know for the insurers, it's all math and numbers, and maybe 25 to 30% is great, and you know, makes it worth it for them financially as long as it's statistically significant. But we have to see. Maybe expanded studies by Sanofi will not show great results. Who knows? That's a risk, so be careful. And then what if there is very bad recession and you have layoffs, right? You have less employees get in the plan because this is free for the employees of this plan, like the employers pay for it and give it as a fringe benefit. And then what if for new hires, employers are going to be like, you know what, like people, the unemployment rate is so high, we don't need to offer fringe benefits because, by the way, the employers are offering this for a different reason than the insurers are. The employers need less evidence because they're doing this as a qualitative benefit for their customers, a fringe benefit. Oh, look, you can track your health. Isn't that cool? We give this to you for free, right? Not saying 100% of them look at it that way, but there is a difference the way the employers look at it and the way the insurers look at it. So in a recession, when unemployment is higher, maybe they feel we don't have to offer fringe benefits. That's a risk to Dario, okay? So just keep in mind all of this stuff. I love repeating the risks and the bear market theses and everything because that's what keeps me allocated. That's what keeps me at 10 or 15 or 20% and not 30, 40, 50, 60%, right? So it's important to know what could go wrong. All right, let's review everything we talked about from the lens of the 4 pillars, kind of summarize it. So catalyst, so far, we're seeing a positive ER reaction to beating those expectations. We have the phase 2 launch of the national insurer. Now, this is going to be an important catalyst because it's not just the fact that a lot of people don't know, assuming it is Aetna, and they find out, oh, Aetna's a big name. Aetna, Dario, they're on the map. Wow, like that's definitely going to be a catalyst for the stock. But the other thing it's an endorsement, right? It's, again, that why is Aetna's name not out there yet? They're not giving permission yet if it is Aetna, right? Because maybe they're not convinced yet between this phase 1 and phase 2 launch, right? They're crunching the numbers, et cetera, et cetera. Now, one of the things which I have to clarify, because on the conference call, Rick Anderson, the head of North American sales, said something about negotiating the pricing for phase 2, which I never heard of before. That was the first time I heard that there was another contract negotiation happening. I thought all the contract negotiation was already done before, and there were determined milestones going from phase 1 to phase 2 launch. Now it sounds like they're negotiating on money for the phase 2 launch. That might be, maybe that's a good sign. Maybe that means they already qualitatively passed what they need, you know, to show it's effective, and they're just like haggling on money. But in any case, my point is that when the insurer is willing to be named, that's like an endorsement of Dario to say, hey, this big insurer company looked at this and we're saying it's cost effective. That could accelerate other insurers buying in at that point, right? So it's not just a sentiment. The reaction to that catalyst is not, ooh, sentiment's better because looking at this big name, but it could actually improve fundamentals longer term and help them sign up other insurers quicker, and maybe employers as well, quicker once this name is allowed to be announced. So that's going to be an interesting catalyst, which for all I know could come tomorrow, right? So we'll see. Now, fundamentals, I'm not too much into quantitative, like how much is it worth thing. I rely on other colleagues and analyst coverage, right? But based on a whole bunch of different models I've seen from analysts, and there's actually one really good guy on StockTwits who's been putting models out. This could be a $30 stock in a year, even if there's a bear market. Possible, right? Now, if it's like a terrible bear market and 10% unemployment and employers aren't signing anyone up, that's going to be a problem, right? But if we don't have that terrible scenario and it's just the NASDAQ's underperforming, and if they could continue to execute, this could possibly be a multi-bagger here, a significant multi-bagger here in another year. So I look forward to collaborating more with some of our colleagues here to nail down what a price could be fundamentally. Sentiment, I think, again, qualitatively, this was an inflection quarter, and I think people are going to start looking at Dario as possibly an emerging leader, possibly the new Livongo. Livongo maybe totally dropped the ball after TDOC bought them, and they're having trouble signing up from what we're seeing, insurers and employers, and maybe Dario is going to take that torch and be the new leader in the space. And I think potentially that's where the sentiment is going specifically for this stock. But then obviously you have macro sentiment against Dario, so you have to keep that in mind. Technicals, we talked about that. It's at a key 50 DMA with, I don't want to say a low, but not an overbought RSI yet. And again, it's the only tech or growth stock or risk asset I could find from 30 plus charts, which was green over the past 30 days, or at least break even or close to break even over the past 30 days, as opposed to every single other stock, which is down still, even after Friday, like 20% plus from 30 days ago. So that's the story on Dario. I think the stock could be at an inflection point, but it obviously is a little bit tricky with the macro situation. If you're part of the StoryTrading VIP community, you can continue collaborating with us in that research room. And we're going to stop here for some Q&A. We're going to go off the record for the benefit of members so they can feel free talking to us here on recording, and we'll be back in just a minute. All right, folks, and that's the Dario story. And to get the latest, make sure to follow us on YouTube, follow us on Twitter at StoryTrading. If you go to our website, www.storytrading.com, you can also find a link to our Spotify channel to get all of our videos on audio only in case that's easier for you. And thanks. We'll see you next week.